Hello, everyone. I'm Victor Kroeger, and welcome to the MNP Fall 2023 Agricultural Industry Webinar. I'm a Senior Vice President of MNP Ltd., the insolvency and restructuring arm of MNP LLP. MNP LLP is one of Canada's largest professional services firms with offices across the country. We have specialized client service groups that we call niches, each with dedicated employees working in them. This allows us to be able to provide our clients and the industry with knowledgeable practitioners. We have identified 16 specific business niches. Agriculture is our largest and oldest niche, dating back to 1958 when the firm was established. As the agriculture niche is so large, it is further broken down to sub-niches, including food and manufacturing, intensive livestock, primary producers, Hutterites, cannabis, and farm income programs. MNP is also the only professional services firm with a farm management consulting group comprised of professional agrologists and consultants who come from extensive agriculture farming backgrounds and bring a high level of technical expertise, first-hand knowledge, and close relationships with the agriculture industry to give us a real understanding of the issues faced by today's agricultural industry. The FMC group supports all of our other service lines in any ag-related engagement, and in particular in every agricultural insolvency or restructuring, where they provide us with expert advice to a specific situation and, if necessary, to be hands-on in a formal engagement. As we're seeing today, inflation growth may be somewhat leveling off. However, there is no indication that the interest rates will be declining in the near future. Along with high interest rates, the war in the Ukraine continues, and now we have a war in the Middle East that will likely affect all of us. John will outline how all of these affect the Canadian and world agricultural industry. John Loeppky from our Winnipeg office, and who is part of our farm management consulting group, will again provide his insights into Canada's ag industry. John is a professional agrologist who has over 20 years experience providing services to the agricultural industry, starting as an ag lender and then as a consultant to the industry. John grew up on a mixed grain and hog farm in southeastern Manitoba and still lends a hand on the farm as required. Our webinar has been pre-recorded to allow you to watch it on your time. At the end of the presentation, you will find contact information for both John and myself for any of the questions you may have. We will respond to these questions as quickly as we can with hopefully good answers. John, the floor is yours.
Thank you very much, Vic, and welcome to everyone today on Halloween. October 31st is the date we're recording this, so we'll just go through the agenda. Going to start off just looking a little bit at some market fundamentals, talk about some trade things that are affecting Canadian farmers these days, and then yeah, as Vic mentioned, we deal with lots of the different commodity groups, so kind of roll through each of them and highlight impacts and maybe some concerns that each of them are facing today as we look forward also into the future, end of 2023 and a little bit into 2024. So, I think we'll start off just looking at what I would call some market fundamentals. Canadian agriculture for a large part is commodity focused and really impacted by supply and demand. I think we always like to say supply is quicker to change and demand usually stays a bit more steady. And so when we see either of those shifting, obviously that impacts pricing that farmers receive and also others through the whole value chain. So important to note, in general, Canada is a net exporter in most ag commodities. So trade is also very important to Canada and trade relations. Obviously, we can't eat our way out of excess supply, so we do need to sell it to all parts of the world, and so therefore those trade deals and trade negotiations are very important to our Canadian farmers. And I think more than ever, it's important for farmers to really understand, the commodity that they're producing, how it's impacted globally, what's happening in all the different sectors and markets that might actually make an impact on their farm, right? Not necessarily that they can maybe change some of those things, but definitely understanding how it impacts their profitability. And some of their income and expense line items is very important. So, within Canada, we're maybe a bit unique in that we do have supply management, where, as the name implies, supply of certain commodities is highly managed, and that's in our turkey, our chicken, our egg, and our dairy sector. So, but even there, supply management is impacted sometimes by global pricing. For example, currently dairy prices on the milk side do have a certain component where it's sold outside of Canada, so it's impacted by the global price of milk. So, you know, since we do land up exporting, a large portion of what we produce, we do have to look at some FX, some foreign exchange, because it definitely impacts the price that Canadian farmers receive. Since our largest trading partner is the US in agriculture, it's also important, obviously, to look at, what our Canadian US FX rates are doing. So, in the red there, we kind of see how we're trading against US, and also threw in, on the green side, the euro, just so we could take a look at that as well. So, I think we're seeing the Canadian dollar weaken a bit in most recently anyways versus the US. So, if you're selling, obviously exporting, that's good. Your prices are relatively speaking increasing. Obviously, there is some inputs that land up getting priced in US dollars. So obviously when you're buying those in, that is increasing pricing on the farmer side, right? So definitely something to keep in mind. And obviously impacting some of those farm gate prices as we move through those changes in the FX. And, as Vic pointed out at the beginning, probably we're going to be talking about some interest rates, and just kind of showed a little bit here, the graph of how the prime rates changed over the recent past here. And so, I think to note, it's not that it's changed, it's a little bit more just the pace that it's changed, right? And that rapid increase. And so it has taken, I think, farmers some time to just, I guess I should say, farmers probably need a little bit more time to react to these rising interest rates. And so to have them hit quite quickly and quite rapidly, it's obviously a big impact, not only to farmers, to Canadians in general, but definitely on the farm gate, we're definitely seeing some impacts, and we're going to talk about that in some of the commodity groups specifically. So. And, I think when we're talking trade, we have to obviously talk about Ukraine and Russia. That is still ongoing. Some of the latest that we've seen, in September, there's unsuccessful talks to kind of revive that Black Sea grain deal, which would really facilitate a lot of movement of Ukrainian grain out of the region. But, Russia's demanding some of those export restrictions on that side. So it's led to more volatility in global commodity prices, especially some wheat, and obviously concerns about food security. We did see some separate, agreements getting negotiated. And we did also see that Russia started maybe attacking some other routes rather than the sea, right? There's some transportation routes down the Danube that Ukraine was utilizing. So really, it is impacting Ukraine and by extension impacting global markets. So one of those impacts we did see was that Cargill sold 25% stake in some Russian grain terminals. So definitely we're starting to see that, you know, some of the global food companies are starting to make some long-term decisions around this, and that was one of them. So one of the interesting things that we did see come out of this, obviously, with the Ukraine having issues exporting, and they're much like Canada, and that they are an exporting nation when it comes to a lot of their ag commodities. So they were flooding the market, if you want to call it that, in the local area with some of their ag exports, and so then we saw their neighbors such as Poland and Hungary kind of, you know, looking at restricting those imports because it was affecting their farm prices. And then in retaliation, you know, Ukraine filed some complaints with the WTO against those companies or countries. So we kind of see this back and forth as every country is trying to adjust, and where they used to have a home for their product, it's now maybe all shifting around, right? So we're seeing some unsettledness over there, just as everyone tries to find out exactly where exactly their product might land up. So, you know, for the coming weeks, you know, we might see that revival of that grain deal after all. We're just not sure where that's gonna come. And obviously, if that comes through, we're gonna see a shift in probably some of the grain markets as a result. So remains to be seen a little bit, but that is obviously one of the impacts of having war and conflict in a major grain producing region is the markets are a little bit uncertain and disrupted, and lots of speculation out there as well. Yeah, when we bring it a bit closer to home here in Canada, you know, recently we're seeing some conflict with India, and so that's really leading to some strained relationships, right? And so what is the impact for Canadian farmers? I think on the graph there you can kind of see that lentils and dry peas are probably some top exports that Canadian farmers are exporting out to India. You know, kind of remains to be seen if there's going to be any impact or retaliation from India, but definitely could be some big impacts to the areas that grow those crops, like Saskatchewan in particular. So something just to keep an eye on. And you know, I guess the other things that we've listed there are some other exports that we see coming out of Canada going into India. So also could be impacted as a result. Also, just wanted to touch kind of an update on Bill C-234. You know, I think the carbon tax is in all the headlines these days. You know, Atlantic Canada is seeing some changes in maybe some of the rules over there. Bill C-234 though was meant to give some reprieve to farmers using propane, natural gas for some of those necessary farm practices, heating barns, drying grains in particular. So looking at some exemptions for those. You know, fuel is already exempt, but this was just kind of going one step further. And it had started, you know, going through the Senate and working its way through there, but was delayed. Obviously, you know, Pierre Delphine kind of raised some concerns about justifying claims, right? That there is actually an additional cost. So, and in that time frame now, Bill C-8 has come up. And now there's some uncertainty whether we should just, or the Senate is looking at maybe just providing a rebate on natural gas and propane rather than making it exempt. So needless to say, lots of uncertainty maybe around that. It still needs to get approved by the Senate, and it seems to be kind of stuck there for now. So we'll see exactly what the outcome is. At this point, we're just waiting to see what that could be. So if we move into you know, some of our commodity groups and some updates there, we're going to start off with poultry. You know, avian influenza is still continuing and is providing, unfortunately, you know, hasn't gone away, and we're seeing it, you know, I think slow down a little bit. Next slide, I think we'll talk a little bit more in depth on that. I think probably for the industry in general, we're looking at, again, some moderate growth. Demand for poultry in general, is still strong as we go forward. It's still a staple. And I think relative to some other proteins, it's still relatively affordable. So one thing we have been seeing, though, is definitely some challenges for any new entrants looking to get into the industry. As we've seen interest rates really increase, that has made it really hard for new entrants to kind of look at penciling out any sort of break even in order to start up some new operations. So, anyone already in the industry for a long enough time frame, those challenges are definitely less. But when you're coming in, that's usually your point when you're borrowing, all things being relative, is the highest, and your margins are just super duper thin at that point. And so I think the biggest thing we've seen is those interest rates as they've crept up. We've moved from a break-even position or slightly profitable in the first couple of years to negative. So anyone looking at getting in, I think status quo probably in the past had already been that you needed an off-farm job just to make it work. But now we're seeing even that is a real challenge. So what does that mean long term? I guess remains to be seen, but definitely we could be seeing, just a consolidation again as new entrants find it hard to actually make a go of it. And for anyone who's just recently got in, probably did not pencil out interest rates as high as they are. So we could be also seeing some of those new entrants making the decision just to pull out. So, but definitely, for an industry that normally is pretty stable, definitely we're seeing some challenges. More so just for those new entrants to get in. The barrier is just quite high at this point. So, and like I said, avian influenza, it was a bit of a rocky spring there, but it seemed to have stabilized. The number of infected premises there we have listed. I think the concern is, as we kind of see a lot of the geese flying north again, or pardon me, geese flying south, we're concerned that maybe those number of infections might rise again. So it's not fatal to geese, but they definitely can be carriers and contribute to obviously a lot more infections as they're traveling through some of those poultry regions. So the good news is there's a vaccine that's been developed. It's starting to be administered in France. It's for ducks at this point, but there is a glimmer of hope that maybe there's an opportunity that we can see some protection in the future. So if we're looking at dairy, I think we're seeing a lot of challenges in this industry. Definitely one that in the past probably has been relatively stable from a profitability standpoint. I think we're seeing a lot of challenges, especially out west right now. With higher feed prices, higher interest rates, some of the other expenses, just inflationary. That definitely is putting a large strain on profitability. So we're seeing reduced profitability to the point of farmers really having a tough time with cash flow. Definitely seeing more farms coming up for sale in the dairy industry. So that's just a sign that some of those challenges are just almost insurmountable for a subsector of the industry. So one of the other challenges is, we're seeing support price increase. I have a question mark there. Comes out, I think, tomorrow, whether they're going to look at increasing that price of milk or not. Dairy Farmers of Canada has already come out and said, they would suggest leaving the price flat. So I think I don't think we're going to see a lot of reprieve if anyone's hoping that the milk price is going to increase and offset some of these rising expenses. I wouldn't hold my breath that that's going to happen in the near future. So And then we also have some trade disputes, and I think we'll talk about that in a few slides. So, I think one of the other things we just wanted to highlight here was, this is looking at just Manitoba as an example, but I would guess that most other provinces would mirror this pretty closely. One of the reasons why dairy farms are finding it challenging is because that, they do carry a higher level of debt comparatively to some of their counterparts. So, and especially, you can see kind of that 4-year trend there. We've seen debt compared to cash income going up and up. So, and probably a combination of debt increasing as farmers are struggling to kind of pay some of their bills, and also cash income not necessarily increasing at the same pace. So definitely 13 times their net farm cash income. That is getting pretty hard to sustain, and so I think we're going to see a bit more pain before we get through any sort of reprieve, or before we get to see any sort of better times on the dairy side. So and kind of what's leading to that, I think we're seeing a lot of working capital challenges. Like I mentioned, some of those inflationary things are increasing faster than milk prices, and we don't see milk price necessarily moving that fast going forward. Feed costs obviously has been a big one going forward. Probably one of the biggest line items you'll see on a dairy farm obviously is their feed costs. And yeah, we're seeing well north of 30% of their milk check going towards feed. Finance again, right? It typically is industry standard was kind of 30% of your milk check is going towards debt. Now we're seeing a lot that are going over 40. So, when you look at feed and finance, that chews up a lot of your milk check, and there's just not a lot left over for all the other expenses that have to get paid. So, and on the trade side, there's been lots of trade deals recently where dairy, has been a part of it, and so now we're seeing some of the impact of that. So even though the trade deal indicated that we were going to be giving up some of our dairy market, I think when it came to actually implementing it, it didn't quite happen that way. So then that's why countries like New Zealand and the US have kind of challenged Canada on some of how we've actually enacted those trade deals. And so obviously when it goes through, we're definitely getting challenged on those, and the ruling is not always coming out in Canada's favor. So even though we've maybe announced some of these trade deals, and dairy farmers have been compensated for them, I don't know if we've necessarily seen the impact of it, and that might be coming yet. So some strong headwinds, I think, for the dairy industry as we go forward. On the other hand, if we're looking on the crop or the cash crop side, the grain side, I think a little more optimistic on that side. So we'll take a look at, kind of 2023 harvest. We'll take a look at some farm equipment purchases, and then we'll just touch on farmland values kind of mid-year. So, as I mentioned at the beginning, we have to look at the US to a certain extent. The prices definitely are set based off of US, and the production in the US also has a big impact on where the future prices are. So, I think basically the two ones we're going to focus on today are corn and soybeans. I think they've had a fairly decent crop in the US. Maybe a little bit lower than what they were expecting, but still, given some of the dry conditions, I think everyone is kind of optimistic that they're going to have a fairly decent crop in the US. So, and I'd say probably same for corn and beans, right? So, kind of expected maybe a little bit higher production, but it's come down as the year's gone ahead, but not maybe as much as everyone was thinking. And in Canada, we're looking at kind of our soybeans, canola, and wheat. Again, yield expectations for beans is just over 44 bushels an acre, pretty flat compared to what was expected in spring. So, I think we're not seeing a lot of surprises on that front. Canola, definitely we saw that drought in southwest Saskatchewan and southern Alberta, which has impacted some yields. So, again, estimated, I think, as a country though, is 35 bushels an acre, and for wheat, I think we're a little bit down from that perspective. 52 bushels an acre was the spring estimate versus, I think now that harvest is mostly done, I think we're looking more at a 46 bushel an acre outlook. So definitely, yeah, something that I think across Canada, the grain sector is doing fairly well. I think they've had a couple of good years. And I think we're starting to see prices slide a bit. So it'll be interesting to see just what the markets do as we go through the fall and into the winter, and see if farmers can maybe capture some of the prices that they've seen this time last year. So, always say a good indication of kind of farmer sentiment is if they're going out and buying equipment. And it definitely looks like that's the case. Two-wheel drive tractor sales are maybe down a little bit year to date, but definitely four-wheel drive and combine sales are up. So I think the sentiment is, obviously we've had some good profitable years on the cash crop and the grain side. So farmers are going out, replacing equipment, buying new equipment, because they feel pretty confident that their industry is doing all right, and that they have a bit of a bright outlook, right? I would say though that when we chat with farmers, they do get concerned about consolidation of equipment dealers. We've seen that a lot, and so what we're hearing, just anecdotally, kind of difficult to get competitive quotes. Service is hard to find sometimes. Obviously, you'll have some good dealers out there, but in general, service seems to be sliding, and I think that's just a function of the economy and the labor force. It is just hard to find good qualified people in general, no matter which industry you're in. And then obviously just convenience, right? Needing to pick up those parts mid-harvest right when you need them is not always as easy as it used to be. So just as the farm sector consolidates, we've definitely seen a lot of consolidation in the equipment industry, and as a result, maybe it's not exactly as competitive as maybe it used to be as the number of players declines. If we take a quick look at kind of the Canadian farm values, this is put out by FCC semi-annually anyways. So we're definitely starting to see the rate of increase, I guess, slow down. Interestingly, BC is flat over the last 6 months. But all the other provinces are definitely continuing to increase. And I'd say, I think what we're hearing is that, yeah, farmers are definitely actively looking at purchasing land. They've had some profitable years. They've got some money in the bank, and so they're looking to spend that as they go forward, and not really seeing anywhere in the near future where they're expecting prices to stabilize or even drop. So I think there's definitely good demand for farmland as we look across Canada still. As we move into hogs, unfortunately, moving from the crop sector, which has had some good success, I think hogs, unfortunately, we're not seeing that same result in this industry this year. Definitely margins are quite a bit lower, and the next slide will kind of give you an indication of that. We're seeing weaker prices coupled with costs that are persistent and pretty high. So on top of that, I think we're seeing challenges on the packer side as well. So You know, the whole industry seems to not be in a profitable cycle, right? The farmers don't seem to be able to extract any margin, and the packers also are having a lot of challenges. So the whole industry, I think, is under some challenges right now. You know, and so we kind of look at Manitoba here, and just down to the gross margin level, right? You can see that so far this year we're definitely seeing gross margin drop off. So, you know, we're looking at $14 a head after gross margin. So that's what's left over to pay all the other bills. So not a lot, right? So I think most producers are probably in a negative position or close to it, and definitely not enjoying some of the better year like we had last year or even the year before that. So I think we're probably going to see a little bit of consolidation again, depending on how long this lasts. Those with bigger balance sheets and more healthier balance sheets can withstand this downturn for longer. So not quite sure how long this downturn is going to go. Certainly seems like crop prices are starting to slide, which means feed prices should follow, and so we might see some reprieve there. But the challenge is that after we get through this, we might just have less packing and shackle space, so we might not even have a home for some of these pigs as we go through this, and we'll get to that in a slide or two here. Just wanted to quickly mention, you know, US, obviously the two, Canadian and the US market, are quite integrated. So we can't look at our Canadian industry in a vacuum. It is part of the larger US market. So, you know, as the slide kind of shows there, we're seeing that, you know, we're kind of down from spring on the US side as far as inventories, slightly up maybe from a year ago. So it's likely a sign that, you know, we've been working through any backed up hog situations, and I think we're at a point now where, you know, there still isn't enough demand in the world market. I think we're a little oversupplied on the North American side. So I think the whole industry is going through a little bit of a right sizing exercise, and unfortunately that likely means that we're going to have some challenging times for a bunch of producers and the packers as well. And yeah, on that front, you know, it certainly seems like Olymel has been in the news the most recently. You know, back in spring they announced a big plant closure. They've also announced a few other closures as well within Olymel. They're closing some barns. So certainly seems like they're really struggling on that side. I know in Manitoba, I think High Life sold one of their Minnesota plants. So definitely, like I mentioned, it is just not good news for the industry in general. Moving on to cattle, kind of the reverse here. I think we're seeing profitability across all points as we move up, right from the farm gate right through processors. So and we have a pretty strong outlook as well for this sector moving forward. So definitely some good news stories, and I know the cow-calf guys need it. They've gone through definitely some tough times, and in Western Canada we've had some feed issues and continue to have feed issues. So so definitely nice to see that that's, you know, we've got some profitability back in the industry. It might be too late for some producers as they've already exited for various reasons, but for those still in it, it's nice to see that we've got some profitability that we're looking at today. So you know, and just a note here, we're seeing obviously inventories slide, and so then, as I mentioned at the beginning, right, supply and demand is always important. So we're seeing Canadian supply, if you want to call it that, shrinking, as we're seeing, yeah, as I mentioned, producers just exiting the industry. It's dry down in Texas, so you know there's just not enough feed in certain regions to support cattle. So So supply is shrinking, and demand, even at higher beef prices, seems to be remaining pretty strong. So all points in the industry seem to be making money at this point, which is somewhat unusual. So and I think it's going to take a little while for the herd to, as a North American basis, just to turn around, right? Biology just indicates it does take some time, even if you want to increase and expand. There's still some biology that needs to happen there in order for that to happen, and we're not seeing that just yet. So definitely seems like supply is going to continue to be short, and so as long as consumers are willing to pay those high prices or relatively higher prices, I think it bodes well for the industry. Yeah, so likely no expansion. As I mentioned, parts of the country, in Canada, we've got limited feed supplies, definitely some higher feed prices and some high calf prices. So important to mention, I think there is some agri recovery, some drought assistance that was announced for parts of Saskatchewan and Alberta. And also there's some areas southwest of Winnipeg eligible for some tax deferral if all of a sudden they're reducing their herd size due to lack of feed. So we're also seeing, producers selling their fall crop a bit earlier. It's running from June to December, so interesting just to see that change. And we're seeing internet sales. That's just an industry trend that we're seeing more sales move over to internet versus live. So so I think we've got some high summer demand. Sustainability might be questionable long term. Again, higher interest rates, right, and high inflation are definitely going to impact the industry. Moving on to wineries, we're seeing, probably saw lots in the news this summer about wildfires in the Okanagan, and they already were coming off of a weaker production year last winter. They had some freezing, which really, I think, cut some of their crop in certain cases down to 50%. So, on top of that, now they've got some wildfires that happened this summer, and impacting certain producers, obviously, with profitability for anyone doing some of those on-premises sales and tours and that sort of thing, got impacted pretty severely. So, in general, I think we're seeing sales kind of slow down slightly, coming off some of those pandemic high levels. Still fairly strong, but definitely coming off some of those highs that we saw a year or two ago. And to note, in Ontario, they reintroduced legislation to remove that 6.1% tax on Ontario-produced wine. So, so that would be great news for Ontario producers if that actually went through. Looking at cannabis, I think it's interesting industry, as I've got it laid on the slide there, 5-year anniversary, right, since legalization. So we've seen a lot of changes in the industry over those 5 years. To note, kind of GDP grew for the first 4 years and declined a bit into 2023. So, but definitely, the industry did show a lot of signs of just a new industry that went through some various stages, and I think we've seen consolidation, we've seen oversupply, all those things. So, in general, I think sales are kind of stabilizing a bit. Inventories are up a little bit. So, but I think, a lot of the growing pains, if you want to call it that, are coming to an end, it looks like, and we're starting to get to some equilibrium, right, where the Canadian companies are matching up with what Canadian demand is. And so if we just, kind of look at the graphic, the slide there, we kind of see that, inventories are up a little bit, sales are up. So definitely seeing more stable production and increasing a bit on the sales side. As we move into food and beverage, I think obviously seeing lots and lots in the news recently about the food and beverage industry. Food inflation is, I think, obviously a lot of the buzzwords that we're hearing, and I think I presented in spring, that the gap between food inflation and overall inflation was pretty wide. What we're seeing as we come into September, which is the last info that we got, that gap is narrowing a bit, right? Inflation's running about 3.8% versus food is closer to 5.9. So, and obviously the Trudeau government is calling the grocers to Ottawa, looking at ways that they can stabilize food prices. They're supposed to be submitting their plan later this week on November 2nd. And so it'll be interesting to see just what sort of strategies or tactics they have. And obviously, those are going to impact the whole food supply chain, right? I'm guessing right down to the farm gate level in certain cases. So it'll be interesting to see, what those changes are that they're proposing and kind of what that ripple effect will be through the rest of the chain. So, but definitely, rising costs continue to impact this industry, and we're definitely seeing consumers moving over to maybe some different products, making different choices in the grocery stores, and those choices appears to be moving to those lower margin products, which just impacts overall profitability for the food and beverage companies out there. And I think, just a little graphic here showing that, sales prices are kind of cooling for both food and beverage. Now, not to say that they're not increasing, but they're just not increasing at the same pace as what they were earlier in the year or last year. So yeah, you can see on the graphics there, food manufacturing is down over 2%, and then I think the beverage is also coming down, not quite as much, as I mentioned, still increasing, just not at that same pace as what it has been in the past. So, and that kind of brings us to the end of our presentation. Thank you very much for joining us, and I'll turn it back over to Vic.
Thank you, John, for all your great insights into the ag industry. There's some positives and negatives that you highlighted there. And we'd like to thank everyone for participating in this webinar and hope you have found this information useful. And we encourage you to contact John or any of our farm management consulting practitioners directly with any questions or comments or concerns that you may have with specific agricultural issues. Any insolvency related questions should be directed to me or any of our Cross Canada Insolvency team. The appendix to today's presentation includes further information about MNP and our Farm Management Consulting Group. This webinar has been sent to all of you as you have requested to be added to our our ag webinar distribution list, and it will also be posted to our mnpdebt.ca website. Please feel free to forward the link to your colleagues and encourage them to contact me directly should they wish to be added to our distribution list. We look forward to your participation at our spring 2024 webinar, and we also look forward to hearing from you with any questions or comments you may have. Thank you for listening and have a great winter.